Hello, good morning all. It's a pleasure to be here. It's a pleasure to see so many of you. I think we talk about post-trading being fragmented, but it has one big advantage, is that we can organize such conference and see so many nice people. So we have to take the advantage with it. We are going to have a discussion on the next steps of CMU, but more focused obviously on the sector of post-trade. I will first present my panelists because they're quite experts on all these fields. So we have Martin Merlin from the European Commission, Phil Brown from Clearstream, Jesus Arminta from Nasdaq, and Dominic from the National Bank of Belgium. I think their full titles are here, but many of you know them, so I thought it was not necessary to go into the depth. Before we start the panel, I wanted to launch two Slido questions, and I hope you're all ready for Slido to just warm us up a bit for the discussions. The first one is between Germany and France, what is the oldest CSD? I don't know how many of you will vote. I hope many. It's a close call. Huh? Okay, probably we can stop there. And there is no real agreement, and I must say there is a reason for that, is that the answer is Germany has the oldest CSD. It was established on the 12th of July in 1949. But Sicovan, the French CSD, was created a couple of weeks later on the 4th of August 49, and so it means that both of them have 75 years this year. So congratulations. I don't know if you even realized that that there was this anniversary. The second Slido question, please. That is a question that is more for, I would say, insiders into the ECSDA organization. So what is the most recent ECSDA member? Okay, I think we can stop the voting there. You see as well that ECSDA has more members than just EU. That shows from this slide. And the right question is the second one. So it's the second Icelandic CSD, and I will not try to pronounce the name. But it was agreed this year that CSD would become a member of ECSDA. It's the 40th member. So with that warming up, I think we can turn to the panel. I have two slides to show before we start the discussion. I wanted to show a revisited slide on the CSD landscape. We all know that CSD landscape is often looked at as the number of CSDs that is too high. And then if you do that, then you compare CSDs. 20 years ago we had 28, today we have 28. Nothing's happened in the industry. And we wanted to bring some nuance into the debate, where possibly it's better to look at activity or assets under custody. And that shows that basically, if you look at the domestic CSDs, the top 5 domestic CSDs count for more than 80% of assets under custody. So that gives another picture of our industry, which I think is important to nuance. If you don't look at the CSD groups, because you know there are groups that have several CSDs in the group, over 90% is just in 3 groups. I think this is important as a backdrop because, and it gives a more positive picture in the end, that our industry is much more consolidated, the activity is much more consolidated than this picture that's always there with 28 CSDs. So we want to bring some nuance here. A next slide is rather this one, because we all know when we talk about capital markets union, we need instruments, we need capital market instruments, we need liquidity. And that brings us to the first question here. So I can maybe stop the slides. So my first question is rather a generic one on CMU. I think Commissioner McGuinness gave an excellent speech setting the scene on capital markets union, so I won't go too deep into that. But in the end, I think we all realize that CMU is about issuers and investors. And the Commissioner mentioned the CMU action plan of 2020, where a lot has been done in the meantime. But it is fair to say that all these measures, a lot of them were targeted at the financial services industry, so at the intermediaries, at the trading venues, at the investment firms, and so on. But what we all need, and we think of this boy at the side of the pool, is more securities. So we need growth in capital market instruments. And so that's the first question I will ask my panelists, is to say, how do we get there? How do we ensure that we have more capital market instruments? And I will start with Martin.
Yes, thank you. Thank you very much. We'll have to see what the new Commission wants to do exactly in this area, and Commissioner Albuquerque will have to define her priorities. But what we think is that we need to work throughout the entire chain. We need to work at 4 levels: investment, the infrastructures, the oversight of the infrastructures, supervision, and we need to work as well on corporates seeking finance. All the elements of the chain are important. When it comes to investors, well, clearly we need more retail participation in capital markets in the EU. And for that, probably we need simple products. We need more financial education. We need to work on pensions, probably as well, to have more retail investors using capital markets instead of leaving their money on bank accounts. When it comes to the other extreme of the chain, non-financial corporates, well, we must make sure that listing is an attractive proposition. We've worked hard on that in the previous mandate of the Commission, notably with the Listing Act, which I think is welcomed by all market participants. But we need to see what else can be done to make sure that we do not discourage listing, and we do not discourage corporates seeking finance elsewhere than traditional bank loans. We are now going to the 27 member states to talk about CMU and the European and Savings Investment Union to all stakeholders. And what we see very often is a lack of awareness among corporates of the opportunities that can come from using market-based finance as opposed to traditional bank loans. So we need to work on that. When it comes to infrastructures, well, clearly we have too much fragmentation. We have inefficiencies in the system. When we look at CSD, it was mentioned by Mr. Jem at the beginning of the conference that we need to find ways to make the CSD industry more competitive. I would agree with that, but more importantly, I think we need to make sure that the CSD industry allows the wider economy and the economy as a whole to become more competitive. So we need to see what can be done in this area, knowing, of course, that consolidation has to be mainly market-driven, but I think we can come back to that. And then when it comes to oversight and supervision, well, at least we need more supervisory convergence, I think. We have some of that. ESMA is doing a fine job, but there is scope to do better. And of course, we'll need to see whether we can have more centralized supervision. But of course, this is an extremely difficult topic, as you know. So I'll stop here and happy to come back on the specific issue of financial instruments. Here, of course, One topic which is very relevant for us now is the issue of securitization. We want to develop securitization in the EU further. The market is picking up in a rather satisfactory way, but we are of course still very far away from the securitization market in the US for a variety of reasons, of course. But we've issued a consultation on that. And this is going to be a priority, of course, developing the securitization market in a safe manner, and that would create capacity on banks' balance sheet to finance the economy better.
Okay, thank you, Martin. Arminta, you may want to add something from the perspective of a stock exchange, how you view the possibilities to basically raise more capital in the EU, I would say.
Thank you, Lisa, for this opening question, which is really central to the CMU debate. And every new policy, institutional or market measure needs to be, I think, evaluated through this lens. Will it bring more companies and more investors to the market? And while pan-European harmonization and integration are essential, they alone will not create deeper, more liquid capital markets in the EU, generating attractive returns. Speaking of which, this year we're seeing the widest performance gap between the US and EU indexes, with S&P 500 outperforming Stoxx 600 by 20%. So as we heard from the Commissioner, and we know, I think, all being the industry players, the challenge is multifaceted, and so should be the response, addressing all pillars of the ecosystem. In the markets that we operate, we have actually a shining example of Sweden, with a thriving capital markets ecosystem, with 660 IPOs, mostly from SMEs over the past decade, strong and really engaged pension funds, and a robust investment culture with more than 1/3 of population holding investment savings accounts. So let's take it as a blueprint, replicate and scale it across the EU. And to make it happen, of course, we will need to continue the actions, both on the EU and the national level. In the interest of time, I'll just highlight maybe 3 areas, and they will, I think they will align well with what Mr. Marlan just brought up. I think we have to hear the voice of corporates and continue to reduce the regulatory burden for companies, to reduce administrative burdens, to simplify requirements and processes, so that companies could have a simplified operating environment which prioritizes innovation and growth. And the Listing Act is a step forward, but then we have reporting rules, disclosure rules, so there is definitely another area where this simplification can happen, because in the end, the benefits of going and being a public company must outweigh the burden and the cost. Now, on deepening the capital pool through institutional and retail participation, I think it came very clearly through many reports that to boost institutional pool, pension system reforms that strengthen the second and third pillar pensions are needed, especially in countries with underdeveloped pension assets. Today, 62% of the EU pension assets are concentrated in just 3 countries, the Netherlands, Sweden, and Denmark. And there is very clear correlation with actually the activity on the institutional side in these markets. To mobilize private savings parked at banks, there are initiatives that would promote financial literacy, improve market access, and encourage investments are needed. And this is where the EU can play a role, for example, with a digital educational program to educate citizens at scale. And we also, again, have this Swedish example of the investment savings account that shows that tax incentives and simplified reporting help convert savers into investors. And the last point is leveraging public investment to catalyze private funding where this is not mobilized yet and is absent. So we have some good examples in the early stages of funding with business angels and VCs and the governments co-investing. The Baltic governments are, for example, set to launch very soon the Capital Markets Acceleration Fund, which is going to anchor some IPOs of SMEs. So this is another area where that could be applied.
Okay, thank you, Arminta. Dominic, from your perspective, do you see some possibilities?
No, I fully agree with what has been said. Again, there is no silver bullet. We have to focus on the different actors, investors and issuers regarding the investors, little investor literacy, tax incentives, institutional incentive, pensions funds, insurance, regarding issuer, SMA, and so on. But let's say, I have the impression we all know what we have to do. The real question is, why don't we do it? And the answer is, again, I think we forgot there is no free lunch. At one moment, you need to take risks. And this is a little bit my concern. I will take the example of securitization. It will provide fund for sure, but again, you have to accept you will a little bit more risk. The same with life insurer of pension funds. We have long-term technical provision that have to be backed by long-term assets. You get very easily redirected to some area like green of digitalization of funding of SMA. But again, you have to accept risk. So from my point of view, I think we all know what should be done. But then you need to make trade-off. There is, I repeat, no free lunch. You will need to accept some risk. And you will need to make choices. You cannot have, let's say, growth, innovation, and at the same time, a very consumer protective regulations. At one moment, you have to make a choice and maybe starting to give in more space to companies to develop, to go public with, let's say, simpler rules, facilitating, let's say, the reporting and so on, to have less burden. And from the moment that they become bigger and bigger, then you can adapt or put different, let's say, regulations to protect financial stability and consumer. But again, no free lunch. You need to make choice, and I really think we all know what should be done. Thank you.
Okay, thank you, Dominic. You mentioned the point of risk, and I think it's part of Capital Markets Union, the need to accept more risk from all sides. Phil, I'm sure that you will have some additional reviews on this that you can add.
It's difficult to disagree with what everybody said, actually. Thank you, ECSDA, Mark, Anna, for having me here. It's a pleasure to be here. I think one of the things that's critical for us to not forget through all this debate is that we're really talking about the health, well-being and wealth of European citizens. Right? It's not really about capital markets at all. It's about how do we help Europe remain globally competitive and how do we help it to grow so that people can live good lives and we get rid of some of the social issues that we're struggling with at the moment. And therefore, I think that the impact on the real economy is what we should be focusing on, not just on what we do in capital markets, and then what do we need to do in terms of action. And one of the things that I would say that we need to be really, really focused on is time, in that what can we do now that can have rapid impact? Because as we've heard from other panelists, what we're talking about is a European capital market and a European economy which is lagging the US and lagging Asia. And if we think about T2S, my first conversation on T2S was in 2006. We're now in 2024. It's 18 years later. And we're still waiting for a release in June next year to enable some of the cross-border settlement to be able to take place. We cannot talk about 2-decade projects if we're going to fix this problem. Right? We have to figure out what we're going to do quickly. On the positive side, Ilse, in the letter report, there are 33 trillion euros of cash from European savers sat on bank balance sheets that could be in the capital markets. So I'll repeat what some of my colleagues have said. You cannot have an expectation to have a capital market, an equities market, which by its nature is a long-term market, without allowing your pensions products and insurance products, which are long-term products, to invest in that market. It's anachronistic that you would have pensions that cannot buy equities. And apart from a small number of markets that Aminta mentioned, pensions in Europe are largely restricted from buying equities. We need a tax system that enables European citizens to buy equities and encourages European citizens to buy equities. Just one quick example. Japan's economy is about the same size as Germany's economy. They both have one CSD. So let's put to bed this argument of fragmentation of post-trade. Japan's capital market is 3 times the size of Germany's capital market, despite their economies being the same size in GDP. Japanese pension funds buy equities. I think the correlation is very, very straightforward. The other thing that we need in Europe is a common safe asset. You know, how do we develop an asset which crosses on a pan-European basis, that's used in collateral operations, that's used as a form of liquidity generation? And I know that it's part of the review that's come out of the CMU work for Letonoy and Draghi, and I'm really hopeful that we'll see something emerge on the common safe asset side. And then the final thing I would say is, we also have in Europe, and I am biased in this, and Ilse is also biased, but I think it's valid despite our bias. We have the unquestionably world's best fixed income finance raising market in the Eurobond market. It's an enormous market that's highly efficient. And if we look at, for example, there's more than 100 billion of issuance in the last 5 years from Chinese issuers who want to raise US dollars. It's a highly efficient market, and we should be using the Eurobond market more in order to pursue growth in the European capital markets. We shouldn't just be thinking about equity. Fixed income, a lot of the growth that we need, particularly in greening the European economy and sustainability, is going to have to come from debt. And we have a ready-made market to raise that capital. I'll stop there.
Okay, thank you. I think we've covered... oh, sorry.
Yeah, you allow me just, one word to fully agree with all my colleagues, but I would like to highlight what Arminta said about the Swedish example. Many times, on many occasions, we see that we're looking for examples outside the European Union, basically the US examples, and I really believe that we have a very good example in the Swedish case. We in BME, we are trying to explain in the BME and in the Spanish market this for the policymakers to convince them that this is a potential model to be followed in the European Union.
Okay, thank you. From all these answers, I think we have the recipe. We know what the menu is. Not completely, but there is a. As Commissioner McGuinness also said, there is a sense of urgency now that we have to act. So to see how the new commissioner will present that, but also how member states will be wanting to act, because that's where. This needs to happen as well, and it's good that the Commission is visiting all the member states to press on the importance of capital markets union. I think we probably all have to do that in our own conversations. Now that we had, I would say, a rather generic question on capital markets union, we turn to post-trade. It's been said already, and it will be said more today. Our industry is fragmented. We all know that. Yet we are a very small industry. I think all members possibly have participants here, so you can. I don't think we're a big industry. We're 28 entities, some of which are really tiny. And then if we look at the EU, we have thousands of banks, we have hundreds of trading venues, and we have hundreds of investment firms. What then makes this CSD industry so important for CMU? And I'll leave it to Jesus to have a first shot at the answer there.
Yeah, thank you, Ilse. Well, I would start by saying that the CSDs are important not only for the CMU, they are important for any financial market, obviously. Despite the German and the French case on the CSDs, most of the CSDs were created in the late 80s and the beginning of the 90s of the last century to give support to dematerialize the physical securities. And I compared the CSDs, as far as securities are concerned, to the central banks for money. as long as the registration, the notary function, the ECSDA role is so important as the central banks for money. And therefore, I think the three functions that we are playing, the registration, the notary function, the central safekeeping, and the central settlement are very, very important for, of course, the capital market unit to be working. And with neutrality, because I would add that as a financial market infrastructure, we have to offer these central services, very important services, critical services, in fact, to our participants on a neutral basis. So actually, what we are looking for the capital market unions within the European Union is CSDs that can play this role not at the domestic level, but at the international, the European Union level. And I think that the importance of the CSDs is not only because of these functions, it's also what we have already done. I think since the euro was created 25 years ago, we have had a lot of consolidation among ourselves. We were talking about Euroclear case, the Clearstream, the Euronext CSDs, Nasdaq, SIX Group, and we have seen the figures that you have shown us before. There has been a lot of consolidation. Actually, we've been, during the last 15 years, cooperating in creating the tool to make us interoperable within the European Union, target 2 securities. We try to make domestic the cross-border settlement. This was actually the first slogan of T2S when it was created. The first idea of the T2S was presented in July 2006, a long time ago indeed. I think the CSDs, and I have to say very honestly, most of us didn't like the idea at the very beginning, but we have in the end cooperated, supported the European Central Bank and the 4 national central banks, the 4 CB, in designing, creating, developing, and now functioning the target 2 securities as a tool to allow us to make it possible to make domestic settlement from the cross-border settlement that we have today. I think it is important to recognize then this role, and we have been, during the last years, I would say during the last 10 years, intensively working in favor of harmonization. Within T2S for settlement, but along the full value chain, asset services as well, we have been intensively working in favor of harmonization. So actually, from my perspective, we have done a lot. And during all these years, by the way, we have navigated over troubled waters in many occasions. We have overcome the problems of the dot-com bubble, the financial crisis, Lehman crisis, the public debt crisis, many banking crises in some of our countries, the pandemic, war situations, suddenly big settlement volumes, and all of this, we have done it, and we have survived to these challenges in the ecosystem, in our ecosystem. So I think CSDs are really important because of this, because of the functions, because of the resilience we all have. And I think looking to the future, CSDs are not the problem. The CSDs, from my perspective, are part of the solution. If we compare the US market, which is completely different, there is one single country, one single nation, legislation, tax. It is obviously possible there to have one single CSD. But it's not the case of the European Union. It's not a single country, a single tax regime, a single jurisdiction. What we need, from my perspective, is for the Capital Market Union, something that works as a single CSD, but don't get me wrong, I'm not advocating of a single CSD. What I think we can provide for the sake of the CMU is interoperability. T2S is the tool that we have for interoperability. And competition, definitely. Further competition. But we have been also observing during the last times increasing competition in the post-trade arena, and I'm pretty sure that it's going to be further. And in the end, all of this, interoperability and consolidation, can only be done if we got the necessary harmonization among our different jurisdictions, tax regimes, and so on. So most of the barriers that we already have, not all, but most of the barriers that we already have, from the Giovanni reports 20 years ago, are in the hands of the public sector to be removed. And I really believe that if we remove these barriers, and of course we still cooperate further for the sake of competition, there are much more to do but we have to recognize what we have already done. I'm pretty sure that we could have a single network of interoperable CSDs competing, serving as a single CSD in the US case.
Okay, thank you. Phil, you want to add something? Oh, sorry, it's Martin. Sorry, you want to add something to that?
Yes, no, briefly, why are CSDs important? Well, all the elements of the chain which I described at the beginning are important. We want to move closer to a deeper, more liquid, more integrated capital market, a more seamless capital market. And to achieve that, you need to remove frictions throughout the chain. And obviously, the end of the chain is extremely important, because if we have inefficiencies in the CSD market, then they are, in the industry, they are then reflected, higher up in the chain, leading to higher costs for investors, complications, or disincentives for listed companies. So they are absolutely critical if we want to move towards a more integrated market. If we have inefficiencies in the CSD market, then we have necessarily, shallow local markets that prevent the free flow of savings to investment across the EU. And this is confirmed by the recent ESMA report on cross-border settlement, where we see that the vast majority of CSDs are involved only to a limited extent in cross-border transactions. So that means that we are far away from the integrated market that we want. And we need to work notably on the CSD market in order to, get closer to what we need in the EU.
Okay, thank you. Sorry. Phil, you want to add something to that?
Yeah, I hadn't prepared a response to Martin, but I will respond to Martin, because I think that I think that what we need to understand is cause and effect, right? And it is, first of all, I haven't seen any evidence that there's inefficiency at the level of the European CSDs. No hard numbers to say, I can see that the European CSDs look like this, the US looks like this, therefore Europe is worse. So if that exists, I'd like to see it. Secondly, that you are correct, Martin, in that the level of cross-border traffic going through the European CSDs is low. Until a year or so ago, Clearstream was 98% of the cross-border traffic on there, which sounds amazing. It was a very small number. Now we're about 50%, with Euronext being the other 50%, more or less, because Euronext have brought their cleared flow into there, but it's still a low number. I don't think it's because the infrastructure doesn't support it. I think there's a whole series of other reasons which are the other rationale behind that. But Ilse, it's interesting because when we were preparing the questions, the question is, what is it that makes CSD so important for CMU, right? And I think you can read that question in two ways. One is, why are CSDs the target in the Draghi and Letter and Neuer reports? Right? Or the other is, how can CSDs help? Right? And I think I'd rather answer the how can CSDs help question. And it reflects back to what Jesus said. First of all, since the 80s and 90s, when most CSDs were created, I think we've understood that our role is to create trust in the markets. It's absolutely critical that Europe's capital markets have trust to bring investors into those markets, and particularly retail investors, where we need to create long-term trust that their investments are secure. So the CSDs play a really important role in creating the trust in the markets. Secondly, I think that the European CSDs have been highly, highly innovative. I think it's really exciting that together with the ECB, the EU, the new legislation that's been produced, and some of the CSDs and bank participants in Europe, we've had these ECB trials for digital ledger and distributed ledger technology. We genuinely are leading the world in this technology, and we're way ahead of Asia and the US. And I think that collaboration between the different market players in Europe can set the standard in terms of where we want to take CMU, or Investment Savings Union, to. So there's another positive angle. I think there's a lot, as Jesus says, I think we have an enormous amount of cross-border collaboration. And I'm not doing a sales pitch for Clearstream today, because none of you are potential Clearstream clients, I don't think. But if you can access all 27 EU markets in central bank money today via a Clearstream account, via a Clearstream Frankfurt account.
And which is the first CSD which jumped on that platform?
Yes.
Nasdaq CSD?
Yeah. And if you're a Malaysian investor who wants to buy Canadian government bonds, the likely route you will take is through Luxembourg or through Brussels to get to that market. So let's understand just how powerful our infrastructure is and figure out the best way to use it, rather than, and again, I go back to my comment earlier on timing. We really need to do things which we can do right now. We should not be engaging in projects which are going to take 2 decades to deliver, because the boat will have sailed by the time we get there.
Okay. You wanted to add, we have to be mindful for time because...
I would add, but later, yes.
Okay, because I don't have the counter here, so I don't know how much time we've left in the discussion. We have a third Slido question, if you can bring it up, please. That's an introduction to the next question, and I think many people already answered. No, a couple of them. So this is really, what initiative in the post-trade area would you prioritize to support CMU? So it's not all, possibly it's all, but how, I mean, to Phil's point, what is the first thing we could do to make a change? We still need some more answers there. Well, the winner is clear. The winner is clear. It's I would say what we know for many years already. It's harmonization. It's pursue work on harmonization, removal of barriers. I think this is what was already referred to. We are on that road, but much more needs to be done. So, which leads me to my third question. I think we have to be a bit shorter than foreseen, because otherwise we'll run over time. So I would like to ask to the industry participants what they think the public sector could do, and the other way around, to the public sector, what you think the industry can do to tackle these challenges. How are we going to tackle these challenges with regard to fragmentation? And so, Phil, which idea do you have for public sector to help us as CSDs to basically remove the fragmentation or reduce it?
I'll be as brief as I can, because I've spoken too much already. So, first of all, getting some of the things like insolvency law and security law harmonized so that investors understand what they're buying into when they invest into Europe. And Commissioner McGuinness, it's a shame she's left, because she's been very open about regulatory harmonization as well in many of her speeches. So, allow natural integration via competition. So a natural consolidation via competition. I think getting the competition authorities in Brussels to take a slightly different tack on a longer term view on how competition can be good, or consolidation can be good. I mean, we've tried to consolidate the European capital markets a few times at Deutsche Börse, and we've always found it difficult to get that through the DG Comp. I think that if you look at the US, that hasn't been a problem that the US have suffered from, and it's enabled them to build a single large capital market. And I would encourage use of T2S more. And maybe one of the things that the ECB could do, which we all do in our industries, is provide volume discounts for large users of T2S, which will encourage more volume to go through. We don't have that today. It's a flat fee. I can't think of any other product in the world where you pay the same price irrespective of how much of it you buy. And it would be useful to see volume discounts at T2S.
Okay, yeah, interesting. Arminta, could you do a compliment what Phil says?
So
what can the public sector do?
I really wanted to comment on the fragmentation, and sorry to break the party, but I definitely agree with what Phil said, that a lot has been achieved, but also looking through the eyes of companies and investors at the industry and ecosystem as such, I think we definitely have gaps, because if today, a company incorporated in an EU country, in an EU member state, even T2S market, while preparing for an IPO, needs to spend countless time and resources to figure out cross-border or internal market post-trade arrangements, and decides whether and where to IPO based on post-trade limitations, we are failing. if an investor holding an account with a large European CSD cannot participate in an IPO or invest in a tradable security issued by another EU CSD, we are failing. And if T2S was meant to facilitate interoperability, and we know it's 1.6, I think, of the volumes, that's cross-CSD in T2S, we are failing. So we definitely have work to do there. And it's quite actually paradoxical because the EU has succeeded in building interoperability in transport, in power grids, in communication networks, but we don't have a financial highway connecting all the member states, and I think that fragmentation hurts. You know, this is what makes companies reconsider going public or drives them outside the EU. So on the industry side, I think we need a commitment and deliver on the commitment to build that full interoperability. And from the authority side, whatever can be done to simplify the process, to lower the cost of establishing linkages, be it central register not only of the company law gaps, but insolvency, tax, securities market laws, standard templates for legal and risk assessments, link agreements, anything works, that would bring us closer.
Okay. Thank you. Dominique, from the public sector side, if I can say it like that, how do you see what the private sector, what can the CSDs do, basically?
But again, harmonization, harmonization, harmonization. Maybe to give another example, ISO 022 for the financial messaging is another example. It has already been said, interoperability. I'm thinking of standardized API, which can also allow a smooth transfer of data. And also what we very often see is that there is margin for settlement efficiency. Let me explain. When we look closer at the lengthy chain of intermediaries for the custody, sometimes, yes, I think there are possible efficiency gains and also reduction of costs because it may be too lengthy. Yes, this is another possibility.
Okay, thank you.
Yeah, allow me just,
Yes,
sorry, this time, Arminta, to a little bit disagree, you allow me. I think among the different CSDs, the highway is already there. The highway is TOS. The thing is true, it's not used as we expected. So we have to understand why it's not yet used, but the highway is already there.
Okay. Martin, you have had a wish list, I think, for what the public sector could do. Maybe you want to react to that, but what do you think the private sector can do more?
Yes, no, I heard Phil saying that we could not have the luxury anymore of 20 years projects, but at the same time you call for a European safe asset and for removing barriers that are deeply rooted in company law, securities law, insolvency laws and taxation. So I'm afraid that removing these barriers is really difficult and cannot be done overnight. Some of them were in the Giovannini report already. So we need to be realistic as to what can be achieved from a public policy perspective. So we'll see what the next Commission wants to do. Clearly, ideally, there are barriers stemming from differences in national laws that we would like to remove, notably in company law and securities law, but that is extremely difficult to achieve. So we'll need to see if it is really efficient and if it makes sense to try and address these barriers again. We've tried in the past to some extent, but it proved extremely difficult. But I do agree that most of the problems are rooted there. Now, when it comes to the role of the industry, I think a lot was said. We need more interoperability, we need more automation, we need to continue using modern technologies better. And of course, if there can be market-led consolidation, reducing fragmentation, that would be, of course, welcome.
Okay, I don't know if anybody wants to add something to the question. Otherwise, we turn to the supervisory question. I mean, we've seen in a number of reports the reflection that and it was mentioned by Commissioner McGuinness as well, we need to reflect on supervision and to have more harmonized supervision. It has appeared in all the reports that we saw, so possibly the supervisory structure architecture will be up for challenge, I believe, might be one of the topics of the new Commission. But then how exactly should we do it? And there are many routes to single supervision, single supervisor. So maybe we can tackle that question and see what specifically can be done for our sector. Because of course, I assume that the discussion on single supervision or supervisory architecture will be different sector by sector. I don't think there is a one-size-fits-all here. So Dominic, as a supervisor, you probably have some views on that.
Yes. So maybe we should not confuse, let's say, the consequences and the root cause. When we are talking addressing the fragmentations, again, the root cause is different securities law, company laws, tax law, and so on. So this is the first point. Do not confuse, let's say, the root cause with the consequences. And even when we are talking about the fragmentation, we should be very careful and very specific to identify the right problem. As already mentioned at the beginning of this panel, when you look at the solo level, yes, you may think there is fragmentation. But when you look at the group level, the three largest groups represent more than 90% of the assets under custody. So again, I am not sure that we are talking about fragmentation when you have three groups representing almost all the assets in Europe. And when we are talking about groups, my first question would be, okay, why not a group supervision? Because it's existed for years in the bank world, in the insurance world. It's working quite well, but it does not exist in the market infrastructure, the CSD. So this would be my first questions. Again, if we go a step further, fragmentations. For the equities, yes, probably yes. For the Eurobonds, again, I don't think so. It's quite concentrated. And if we want to have efficiency gains, if we want to, let's say, free capital, I will give you some example from my own supervisory job. When I look after ICSDs, and there are two around the table here, Euroclear and Clearstream, yes, they have to apply not only CSD regulation and banking regulations. And believe me, because I am in charge of the supervision of the regulations, it's a lot. The first question, if you want to have efficiency gains, why do we need to have two different complete, very heavy supervisory rules for one and the same business model? Another example is with the reporting. Very often when I meet, let's say, managing persons from the financial sector, they ask me, what do you do with all this reporting that you are asking us? Because we at the board of management committee level, we take our strategic decision only with 5% what you are asking us. Explain me, what do you do with all this data? And to be honest, I am struggling a little bit to answer these questions. Again, there are possibility of efficiency gains. So my conclusion is, in this kind of questions, we need to have to come up with a business economic solution and not a political one. Thank you.
Okay, can we have a non-political solution to this, is the question. Maybe you have a view on that?
Well, no, I would agree that more centralized supervision is not a panacea. We have problems elsewhere that we need to tackle, as difficult as they are, and we mentioned those. That said, I think it is well established that insufficient supervisory cooperation, diverging supervisory practices are listed as major barriers to efficient cross-border settlement. And if you look at the work that we carried out for the CSDR review, you see there examples how ineffective cooperation between authorities, insufficient supervisory convergence, increase costs, and decrease efficiency of post-trade markets. And of course, as we said earlier, these costs are then passed on to investors and into issuers. So we made some progress recently, notably with the CSDR refit and the creation of mandatory supervisory colleges. We hope that those will help to some extent. We can also perhaps envisage colleges for corporate groups. We think that this would be more in line with the reality of the post-trading landscape, and notably the existence of pan-European FMI groups. So that can be discussed. As I said at the beginning, probably in this area as well as in other market areas, we need more supervisory convergence. Again, ESMA is doing a fine job, but we can probably do more in that respect. And then, of course, question mark on whether there will be political appetite to go further and have more centralized supervision. But that is really a political discussion, and we'll see what our political bosses want to do in that respect.
Okay, thank you. Arminta, you want to
Yes.
answer from your perspective, maybe to the question of group supervision, because you may be also possibly benefiting from such arrangements?
Sure. I think a European supervisory authority and this consolidation of or centralization of supervision can be quite instrumental and helpful in ensuring a level playing field, fostering competition, and bringing consistency in interpretation of enforcement of different regulations, especially related to cross-border activities where fragmented oversight brings those inefficiencies. However, I think I would like to build on the point raised by Phil, because I cannot agree more that speed, time to decision-making and action is of essence. So centralization must not sacrifice agility. Just the EU cannot afford delays and additional bureaucracy, because speed and clarity in decision-making is actually of essence. And we have an example, the successful corporate merger of the 3 Baltic CSDs, relicensing, replatforming, creation of a single rule book, a single operating model, all within 2 years. And this would not have been possible without the endorsement and collaboration of 3 governments, 3 FSAs, of course, us as the operator of the CSDs and the market participants. So speed and agility and flexibility are virtues that need to be preserved, and therefore it is a complex matter, and a calibrated and well-balanced supervisory architecture is needed.
Okay, thank you. I don't know, Jesus, if you want to add, because you are in a group that is in EU and outside EU, so you may have a particular challenge there?
Indeed, we are on a sort of bridge between the European Union and, of course, the Swiss market. But from the supervision perspective, what I would like to say, basically two things very quickly. From the supervision, centralized or decentralized, on the same page as I mentioned before, and taking into account the reality that the European Union is today, I really believe local supervision is advisable and the only possibility from my perspective in the near future. Indeed, further cooperation, further coordination, it is important, obviously, but I really believe we've got different regulations, sometimes legislations we have seen. Indeed, it is difficult to pave the way to dismantle these barriers. I fully agree with Martin. And therefore, the different languages, all of this, from my perspective, needs a single, not a single supervisor, but a decentralized model. And finally, few words on regulation. We need regulation, definitely. We actually is the basis for our business, in addition to technology. What we need is better regulation, and I really believe the public sector is trying to improve. I recognize during the last years the public consultation and the involvement of the private sector is something that I very much appreciate. But I think my point is that it's not only on the theoretical regulation and legislation what is needed, which is important to have on a theoretical basis very good relation, is whenever we have to put in place and develop the technology because of the new regulation and the changes, please be aware we've got a lot of new regulations, that the velocity in the changes of the regulation is very high, and that sometimes the same resources, the same expertise are dealing with different projects at the same time, and there is a bottleneck in many, many occasions in CSDs and at the participants and the stakeholders. That's something that I think we should try to improve in the near future as well.
Okay, thank you. I believe that we've exhausted the questions I had prepared, but we have some questions on the Slido. So it's an obvious question. How can we reduce fragmentation if we believe we're unable to dismantle the barriers? Because that's a chicken and the egg problem. We know for long that the barriers are there, that many of them are national barriers that member states should remove. How can we nevertheless navigate in this complex world? I don't know if you want to...
Just very briefly, I'm not saying maybe I sounded too pessimistic, but I'm not saying we are unable to dismantle the barriers. Just wanted to be cautious and realistic. It is exceedingly difficult, and it would take a lot of political will in the 27 member states to come to an agreement on the harmonization of some essential elements of securities law, for example. And we have company laws which, philosophically are sometimes very different within the member states. And how to harmonize that is really an issue. So I'm not saying that we should not have the ambition to address at least some of these barriers, which can help reducing fragmentation, but politically it's going to be quite a challenge, and we have to determine whether it is wise to spend several years of work and effort in order to try and achieve that. But I'm not saying it is impossible.
But is a 28th regulatory regime the solution to that then? Because that seems like a sensible compromise situation.
Well, we've tried 28 regimes with mixed results in the past in other areas. The company law statute, for example, the personal European pension product. Arguably, the UCITS regime also initially was a 28 regime, and that one proved extremely successful. So I do not exclude that indeed, but it's one thing to consider.
If I may add, I think it's not either or. Just since time is of essence, and this seems to be we seem to be in agreement on that. We shouldn't wait until the barriers have been removed, but we should address some lower hanging fruit, like actually employing the financial highway that we've got and facilitate more fluid movement of securities within the internal market.
Okay, good. Someone else wants to chip in? I think we may want to close the panel now because we're already running a bit late in the conference, I think. So I would like to thank you all for this very insightful discussion.
Thank you.